We are talking today with Mark McCollom, Senior Managing Director with Griffin Financial Group. Mark, good to be with you today.
Thank you, Dan.
You do a lot of work in deals, bank deals. What's the environment right now in banking for mergers and acquisitions?
Yeah, for a bank M&A, what we're seeing is a slight increase in total volume of transactions compared to last year. What we're seeing a market increase in is an increase in banks wanting to talk to one another. I think that's a result of just still a lot of the economic headwinds that you're seeing with, it's still a real struggle for banks to generate earning assets, which is actually, I'll speak for a little bit about the M&A market more broadly beyond just bank M&A, but banks are struggling so much to find quality loans that they're realizing that in order to maintain their own profitability, they need to control their costs better. And to control that cost better, that comes from getting size and scale.
Now, why the struggle finding loans? Is it that businesses are still reluctant to borrow, or is something different happening?
It's a combination of things. Yeah, I think when you looked at the at the beginning of the Great Recession, you had both consumers and businesses were deleveraging their balance sheets, taking on less debt. You still have high levels of unemployment, which is making, I think, the consumer a little bit more reluctant to take on debt. You did see some pockets, such as in residential mortgages. You've seen really high numbers of loans being granted the last couple of years, but that's been predominantly refinance business. We now see, when you look at the projections for, I just saw these this morning, that 2013 mortgage volumes are expected to drop about 16%, and in 2014 another 26%. So that's one big pocket that a lot of banks have on their balance sheets that would potentially go away. When you then look on the commercial side, you had a lot of overbuilding, particularly sort of along the I-95 corridor, from the Philadelphia suburbs, in New Jersey down into Maryland, and it's going to take we think a few more years for that to come back. So then, as a result of that, what you then see though is a case where in other businesses outside of banking, if you just look into manufacturing and healthcare and other lines of business, we see that, and what we're telling some of our clients in the broader Griffin platform outside of just the area I manage, we're telling clients that, hey, the access to leverage is there. If you're looking in healthcare, to do a transaction, if you're looking in just core manufacturing to look to get bigger and have one, what in our parlance we call a strategic, one competitor buying another competitor, right, as opposed to private equity coming in and buying your business. We think that the debt financing is there from the banks because, again, going back to the banking sector, they're so starved for
they want to
assets.
lend.
Yeah, absolutely. I mean, banks. What you've seen is that a lot of loans rolled off the last 3 to 5 years, and the replacement rates on that cash, if you're sitting on cash, are horrible. So the one thing that's leading a lot of banks to talk to one another is that net interest margin, or the difference between what we generate on our loans versus what we pay out in our deposits, that net interest margin is going to compress, just through core fundamentals over the next couple of years. And we saw it compress a lot in 2012 versus 2011, 2013. Now we're seeing it again versus 12. With that kind of pressure, which for a typical bank, that difference between what you lend out and what you pay on deposits is anywhere from 70 to 80% of their revenues.
The smaller it is, the tougher it is for the banks.
Exactly. So as that net interest margin continues to get thinner and thinner, and this has been, by the way, for the banking industry, this is a 25-year phenomenon or more. Where margins started up around 5%, and today they're around 3.5%. It doesn't sound like a big number, but when you're relying, for 3/4 of your revenue to come from that one pocket, and now in just a 2-year span, we're seeing margins go from maybe 370 range down to about 3.3. So a pretty sizable decrease on a percentage basis, decrease in their margins.
So those margins narrowing mean banks are more likely to seek out mergers or deals?
We think so, possibly. Yeah, we think that's just one of the headwinds. I mean, you also have costs of doing business, regulatory compliance under the Dodd-Frank Act that a lot of, I think that, just, general people in the population have heard of. Dodd-Frank has really, added layers and layers of complexity to bank compliance. So that cost of compliance, obviously, if you can spread it out over a bigger balance sheet and a bigger employee base, it hurts you less than if you're a smaller community bank that, in many cases, has to deal with that same level of compliance. So, we think that while it's not impossible for small community banks to continue to survive and thrive, I could list dozens who are doing quite well. We think that for many, many others, we think that the combination of very low nominal levels of interest rates, a struggle to generate earning assets, and then the cost of compliance. When you put those three together, plus what you're starting to see then is for the bigger banks, capital is starting to come back into the sector, because the one thing that has happened in the banks is that we've cleaned up our credit problems. So for the larger banks, the Fultons, the Susquehannas, the Nat Penns in our market, that they've actually seen really nice increases to their stock price in the last couple of years.
Because they don't have as many bad loans on their books.
Because they don't have as many bad loans as they had before, and some of those other issues like cost of compliance, it's easy for them to deal with it because they've got the balance sheet. Yeah. So by having a stronger stock, or in our lingo, a stronger currency, with which to use for acquisitions, we're now finding that if you're one of those smaller banks struggling with a lot of those headwinds, 2 years ago, 3 years ago, you would look and call someone like me up and say, well, are there any options? And the answer is, well, no, kind of everybody's struggling right now. It's all got to lock arms and sort of weather the storm.
Right.
Whereas today, what we're seeing, a lot more people interested in actually growing their balance sheets, via acquisition, and they have the stock price to be able to do it.
I just saw something today that businesses, the amount of cash that they were sitting on is going down, so it's a sign that companies are more willing to spend what they had been previously hanging on to.
Yeah.
Have you seen any sign of that in the markets that you work in?
Yeah. I think for the banks, the banks are clearly still sitting on way too much excess cash and in need of loans. I think that is true, in just the broader, manufacturing and commercial businesses that we cover through the rest of our company.
Talk about that. How the general Stevens and Lee more broadly?
Yeah.
How what is it that you're hearing about the general economy and what direction it's headed in for 2013? There's still the sequester from the federal level and potential ramifications for defense contractors, for example.
Yeah.
What are you hearing?
Yeah. Well, I think that our broader platform actually weathered through the recession well, and we did so because we have different vertical industries that we tend to specialize in. Banking is one of them, insurance is another, healthcare is another, just general commercial and industrial businesses is another, and then technology and emerging markets is another. Because we have these, a broader-based platform, it's allowed us to weather the storm. I think as we're speaking to the various clients in those pockets that we serve, healthcare I think continues to be very, very strong. I think if you had a niche healthcare company that you wanted to sell and partner with somebody, you would get a very strong price for that today. As opposed to if you were in a more staid manufacturing environment that's been maybe slower growth, or maybe even a little bit of negative growth through the recession, and now you're just coming out of it. Well, now you're starting, maybe you had negative growth through the recession, now you have very slow growth now, but that's not necessarily enough that you're going to get a premium price for it. If you want to sell your business, you'd have private equity very, very interested, because private equity has all of this cash that they want to deploy into buying up different companies, but private equity is also more of a bargain buyer. So what I was saying is that for private equity has a lot of excess cash that they raised, in the depths of the recession, to buy companies at a bargain price. They're still willing to buy a lot of these companies at a bargain price, but for a lot of the owners, they're not willing to sell for that price. So instead, where we do see activity, merger activity occurring in those non-hot sectors like telecommunications, energy, healthcare are very hot sectors right now. In the sectors that aren't as hot, what you see is strategic buyers, competitors, able to get bank financing at very favorable terms if they're willing, to pursue them.
Mark, that sounds like a good place to stop on. I appreciate your time today.
Okay, great. Thank you very much.